and welcome to Market Domination. I'm Julie Hyman, Myles Udland in for Josh Lipton today, live from our New York City headquarters. We got 1 hour to go until the market close, and we're taking a look at the major averages here. So let's take a look at what's going on with the Dow right now. We do have this rebound that is going on today. And Myles, it seems as though a couple of things are working in the market's favor today. One, it doesn't appear that we're going to have a government shutdown. And two, no new tariff headlines today. So the Dow right now is up almost 600 points, 1.5%. The S&P 500 up by nearly 2%, and the NASDAQ is up by 2.3%.
Yeah, and I think if we look at today's action, you get to go into the weekend feeling a little bit better, perhaps, than we had been feeling earlier in the week. But I was sitting with Jared. I know we're going to hear from him in just a second here, and we're kind of talking through the market action today, what to make of it. We're going to talk about some of the quantum names that are doing the leading. And there are just still some things underneath the surface that don't make this look super healthy. And also, I don't think on a, as you mentioned, no news kind of Friday, on the sort of week that we've had, folks who had their guard up in this market or who are concerned about the state of this market necessarily go into the weekend feeling a whole lot better. I mean, It's still quite a mess out there beneath the surface. And just looking, we can rip through some individual names, but just some of those charts and some of those structures, the setup, as some might say, still kind of sloppy, to say the least.
Just real quick here, let's look at the week, right? Because to your point, it's not as though this is an all clear, right? Like that's not the vibe here with this little bit of bounce today. We're still down 2.5% on the week for the S&P 500. And if you look, say, at the 1 month here, it's not looking good.
And I think that the 1 month is also instructive, and I still can't get out of my head the February 19th symmetry between 2020 and 2025, that being the high. But the speed, like the momentum that we brought to the downside over the last few weeks of trading, we are only 3 weeks away, less than 3 weeks removed from record highs. So we have really come a long way in a short amount of time, which on the upside, we have people come by and they'll say, well, this makes me nervous. And then on the downside, I think it's going to be the same thing, right? Because markets sort of correct through price or time, but then when you sort of see the velocity of these moves, and we can get into whether the uncertainty warrants this kind of trade or this kind of rethink, I think, from a lot of folks on their outlook for the market. But there's clearly something amiss, let's say, in the broader sense.
I think that's safe to say. All right, let's look at the sectors on the move today, because it is a broad-based gain that we're seeing in terms of everything sort of rallying. Energy, tech, financials, consumer discretionary, all of those are outperforming the market. But we might as well look at that 5-day again, right?
Yeah, and I think this is again where you kind of have to look at today. And you can't feel, I mean, look, market's up 2%. Like, who am I? But it's just an inverse, right? Everything that's led on the way down is now, leading on the way up today.
The difference is that energy is the winner of the week, I guess.
Yeah, so energy, you get a little bit more, I guess the lack of maybe tariff headlines there, right? Kind of supporting that a little bit more. But, you've seen, again, it's just, the rotation is, it's not orderly, let's say. Although, I've seen it argued that it is an orderly sell-off.
It's not a chaotic sell-off, but I think what you mean to say is it is not a thematic necessarily. So in other words, when you say orderly, you mean like it doesn't necessarily make sense in all ways.
It's messy, I think, is the way I'll
All right. Well, stocks are indeed recovering today, but concerns are still mounting, and it's got Wall Street taking a bit of a step back. Earlier this week, for example, Citi downgraded its outlook on U.S. equities to neutral, saying that, quote, U.S. exceptionalism is at least paused for the time being. For more, let's welcome in Dirk Viller. He is Citi Head of Macro Strategy and Asset Allocation, one of the folks behind this call to go to neutral, and in particular to go to neutral on U.S. stocks. So, Dirk, what was sort of the turning point for you? Because it felt like a lot of firms were sort of holding back and waiting to see how long is this going to last, how far is it going to go, before saying, okay, we have to change something. What for you was that catalyst?
Yeah, good question. I would say, just to clarify, we went actually neutral globally on equities already in February, mid to late February, but we kept the US as an overweight. And the main question to us was, do we have the right overweight? Or is it not just about a more shaky equity market, but also about US exceptionalism fading? And I think we got our answer on that over the last few weeks, because what happened was that the US data keeps disappointing. It's really quite soggy, even though the job cuts from Doge and so forth haven't really hit the numbers yet. I mean, our economist called the last NFP print the last strong NFP print, and it wasn't even that strong. Right, so we've seen this weaker data. At the same time, we got really quite positive news out of both Europe and out of China. And in particular in Europe, we had, of course, this really big fiscal announcement from Germany, but broader than just Germany. And that means we are upgrading, actually, our GDP numbers for Europe, for Germany. We have upgraded our forecast for China. So it seems like we're not saying the US goes into recession and we have to panic and sell everything. We are saying, the US still has a little bit of a shaky period ahead, and there might be better opportunities outside of the US. That's more the call, to be honest.
And on the Europe side of that, Dirk, I'm curious, in those conversations with clients, like how, I don't want to say jumpy, but it feels like we've been waiting for years and years for there to be a reason to finally be excited about what is happening, both on the equity side and just the economic setup in Europe. So I guess, how did your view kind of evolve on that as a firm, and then what have those conversations been like with clients as you talk through that kind of thinking?
No, it's another good question. So one of the big questions that I get, so why did you upgrade China and not Europe, right? And so I would say our European equity strategy is also positive on Europe, but we decided to go for China. And I think on the European side, in the end, you have to ask yourself, eventually, will the AI story come back as a narrative driving the market or not? And if it does, it's basically about China or the US, or both, right? But it's probably not about Europe. And the reason why we called it a pause in US exceptionalism is really because we think eventually the AI story will come back. I don't think it's the right thing to bet on for the next 2 months, but eventually it will come back, and then Europe will not be able to keep up its outperformance. I think the reason why people jump a bit in Europe is not just the European headlines, because there you could say, how much will the Germans really spend? I mean, by the way, the biggest expenditure increase in public investment in Germany ever was 1% of GDP, and that was when the reunification happened, and they basically inherited,
entire
half a country that you had to rebuild, right? And so the numbers that are thrown out there might be a little bit exaggerated to basically make sure both Mr. Trump and Mr. Putin know they're serious. But so that the market could have doubted. But the reason why the market jumped on Europe too is because it happened at the same time when the US turned a bit more sulky in data terms, right? So in a sense, if you do believe in the end it will be again more about AI, at some stage China, to our mind, is better than Europe, but Europe has also its merits during this difficult time for the US.
I want to dig in on Europe a bit because you are yourself German as well, so you have that perspective on your home country. And you sound a little bit skeptical. I mean, there's been a lot of optimism that, okay, Europe is finally changing. Europe is going into a more stimulative mode. Maybe even culturally, you're going to have a more pro-business feeling throughout the continent. Is that going too far?
I mean, I would say I've done emerging market research for a long time. The problem with speaking to locals is always they're slightly too bearish. So I take it with a pinch of salt. But I would say the government is a coalition government. Right? It will be very likely a coalition government. And so not that much can change. Actually, the coalition partners are really quite opposed in most of the important views on the economy and everything. So it will be a very difficult balancing act for the new chancellor once he's in place. And so I'm not that hopeful that it's really a sea change. I think, as I mentioned, if it hadn't been that the US is suffering weaker data at the same time, the whole story, the market might not have gone for it as hard. Having said that, it is true that the numbers that were dialed up, 20% of GDP, right? I mean, it's completely unheard of in certainly for Germany, but even globally probably. It's just, I do think, yes, the actual spending will be on the smaller side. And secondly, there's a big the multiplier on defense spending is very low. Of the procurement spending, actually 80% goes straight to US corporates right now, to US defense companies, right? And then, of course, not everything is procurement, and clearly in Europe the mood has a little bit soured on buying US defense goods, so they're trying to source more domestically, but it will be difficult. Right? They have not built a defense industry, so what do you buy? Right. So the trade will continue to work, but probably more likely because we're still a bit concerned about the US rather than we keep raising our European numbers.
So maybe then, Dirk, I know we're bouncing around a little, but we'll finish coming back to the US and that story. And I'm curious how you've maybe tried to disaggregate the story for the economy over the last 6 months and some of what we've seen, particularly in the US labor market, that softening, how that plays into the corporate profit story, and trying to divide that with the more recent let's say, uncertainty around the direction of policy? Are those interacting? Are those separate pieces? Are those, how do you see those resolving together, separately, so on?
Yeah, I think initially it was all about tariffs, right? That was the only topic that really mattered to the market. And we moved from the reason why we downgraded equities overall in February, by the way, was we thought we were moving from the Trump sentiment phase to the Trump delivery, meaning tariff phase, right? And but on the tariffs, it became more about uncertainty surrounding tariffs rather than the tariffs themselves, right? Which seem to be changing day by day. So it became hard to trade the tariffs. But having said that, one really important thing to take into account is the markets behaved completely opposite from 2018. In 2018, when the tariffs came, basically the countries that were tariffed underperformed and the US outperformed. This time around, the countries that are the main targets, meaning Europe, China, even Mexico and Canada, they outperformed the S&P. And one sort of narrative surrounding that, which I think is right and which our economists are telling, is that if you mostly tariff one country, meaning China in 2018, right, you probably hurt that economy, but you don't get hurt yourself all that much because in the end there are other suppliers who buy more from Mexico and it sort of works out. If you tariff everyone, including Mexico and Canada that are really very tightly integrated in the supply chain, you pay a bigger price yourself. And I think that's partly what's going on, right? So the tariffs are still super important for what is happening right now. April 2nd, I'm not sure whether we get a release that clarifies what exactly will happen, but certainly in the mind of the market, it's a major, major date that we have to be careful around. And but then you point out there's a labor market story which is slightly separate, right? It could be linked because maybe the trade uncertainty depresses investment, but the labor market story is somewhat separate in that that's a Dow story to a large extent. And you saw the Challenger survey last week was off the charts. And all those numbers haven't really fully hit the labor market yet. And there is a question about the multiplier, right? How many suppliers to the government get impacted for every bureaucrat that loses a job?
And so we still don't know that.
Yes, exactly.
Piece. I want to ask about a date further out, or a thing that the market wants further out, which is the tax cuts, right?
Yeah.
So you have two things that could happen here. You could have a tax cut extension.
Yeah.
You could have additional tax cuts.
Yeah.
What happens if the additional tax cut? I mean, it seems like the base case is the tax cut extension is going to happen. If there aren't additional tax cuts, what does the market do?
Yeah, I mean, the reason why we didn't fall in despair and go negative equities or or call for recession or anything is partly that yes, the Trump agenda has many good parts for the market too. It's right. Just the sequencing is the opposite of 2018. Right? 2017 was tax cuts. 2018 was tariffs. Now we have tariffs first, and then the tax cuts. And the tax cuts will be smaller than they were, of course, in 2017. So it's not as big a deal. But yeah, I mean, I think the consumer will be weakened by the impact of the tariffs in some shape or form because inflation expectations went up 40 basis points 1 year. Since the tariffs on China were put in place. So there is a negative impact. And if you can't offset that with tax cuts, then there is a weakening force in place. Again, you can debate the size. And we're coming from very strong growth. And so maybe by itself, that's not enough to push the economy into recession. We don't think we will end up in a recession. But certainly, tax cuts would be the positive part of the agenda. And if we get tariffs behind us and can focus on that, that would certainly be very helpful for the market, yes.
That's what the market's hoping for. Dirk, thank you so much. Thanks for coming in.
Of course. Thank you.
We're just getting started here on Market Domination. Coming up, Tesla is bouncing back today, but it's been getting hit hard year to date. We'll hear from a Tesla bull who's still a bull on the other side about why he remains optimistic about the EV maker. And at 3:30, it's the latest edition of our series, Goodbye or Goodbye. We'll take a deeper dive into two stocks to help you make the best moves for your portfolio. Stick around, much more Market Domination still to come.
All right, let's take a look at shares of Tesla. That stock is down over 45% from its record highs back in December. Stock here up about 4% to round out the week. But again, we were off 50% from those records just a couple of days ago. When it comes to negative news flow, the company really has seen it all in the last few months. Tariffs. We've got Musk's government roles, EV competition, and a sentiment washout in the name. Joining us now to discuss is Tom Narayan. He's the lead equity analyst of global autos at RBC Capital Markets. So Tom, you have a buy rating, $440 price target on the stock. I'm just curious the questions that you've gotten, from clients, from colleagues, from peers last couple weeks, as you kind of look at this story, which simply on the stock price has sort of come undone at this point.
Yeah, and I think we have to put things in context, right? I mean, post-election, the stock doubled, right? I went from 700 billion market cap to 1.4 trillion. It's basically back to where it was pre-election. So let's put that all in context. Now, the questions I've been getting asked have to do with really two topics. One is this new affordable car that's supposed to come in this semester, right? H125. What is that exactly? Also, what's going on with deliveries? Why they've been so sluggish in January and February? And the second one is about this June robotaxi product that they're going to unveil in Austin, and whether we'll have unsupervised FSD or not. I think a lot of investors are looking at this move in the stock and trying to see if it's time to start owning the name.
So, Tom, I want to follow up on that first point. Thinking about a name that is this volatile, especially this size. I mean, this is a company that was, $2 trillion at its peak in terms of market value, something close to that. Just how you, as an analyst, handle that process. It's a feature of Tesla's stock. It makes the fundamental story perhaps more challenging. But I'm just curious how, over the years you've managed, with your team to, make sense of or learn to understand that this is the kind of stock that's going to be moving 10, 20, 30% in a couple weeks or a couple months. And there's just a lot of names in the market that won't do that in years.
Yeah, I mean, the answer is we don't really worry about that. So the way we look at it is we try to look at the fundamentals of the company and the stock. We try to assess what the individual piece parts are worth. And, if there's some news events like the election and what some folks may think that could mean or not mean to the stock, that maybe that's noise, So the way we look at Tesla and why we have, our valuation the way it is we look at the total addressable market size, autonomy, robotaxis, FSD, and that's the lion's share of our valuation. We think that's a tremendous value. We don't only think Tesla is going to dominate that. There's other players. It's just we think mobility, which is cars, etc., is going to expand to be much bigger than what it is today, because autonomy effectively increases the value to consumers so much more than what it is today. So we're looking at things from that perspective and not really listening to all the noise.
Tom, I know you call it noise, and I get that, but you're looking at a situation now where Elon Musk, if you look at the latest poll numbers, people hate the guy. I don't think it's an exaggeration to say many Americans do. It is affecting sales. You got people setting Teslas on fire in France, for example. So at what point does it become more than noise? I would argue, if you look at the sales, it probably already is a little more than noise. But at what point would that actually affect how you view the stock? What would have to happen, I guess, for you to say, maybe this is a risk?
Well, this is a question I get asked a lot. What I would say is, let's say this was another car company that had the numbers they posted in January and February, and were doing the things they were doing in those months, right? So you had an intentional shutdown for the Model Y changeover that was articulated to the market in the Q4 call. We knew that was happening. January and February are really weak months anyway. And sure, you have some models that are very long in the tooth, right? Model 3, Model Y. You also have this Osborne effect, people seeing that there's going to be a Model Y changeover and the new affordable car. So folks could have been potentially waiting on that. So there's a lot of reasons, and I think the headlines that you saw in the press, no offense, was a lot of, car sales are down 45% in Europe, right? In the month of, was it February or January? But that's going from 14,000 to whatever, 7,000. The company sold like 1.7 million cars, right? So they're looking at the percentage change, but these are tiny numbers we're talking about. If this was another car company and all of these things were happening, I think I would understand, okay, this is what's happening. Now, this extra component that's, I think it's been talked about obviously in the media and everything. It's probably getting a lot of attention. I don't know, honestly, if that's what's driving the weaker sales. I think a lot of folks look at a car purchase as I need to buy this for my family. What is the best EV in the market today for the range and the price? Maybe if I was making a purchase of soda in the grocery store, that's a discretionary item that I can maybe boycott more easily. But a car purchase, I don't know. I tend to think people are going to buy the best product, what's best for them. And looking at the data that we have, I don't know there's enough to say that, all of this is because of, some of these considerations we're hearing about.
And so then, Tom, we'll just finish looking forward for the company. You mentioned, we have these events, thinking about, the company's going to have, not a mobility day, but something like that, right? Which they had, I think it was last August. They'll have another one coming up later this year. What are the key things with that? You mentioned some of the FSD features you're looking for. How are you thinking about that kind of event? And then, real pie in the sky, the Tesla robots, personal assistants, all these sorts of things. How you look at that product roadmap really for the company over the next year.
Sure. The main catalyst, I would say, is number one, this new car, this affordable car. What exactly does it look like? How robust is it? How differentiated is it? And then number two, to your point, this June rollout of their robotaxi service in Austin. What does that look like? Is there a driver in there? Is it completely driverless? Will it be unsupervised FSD? That would be an amazing breakthrough, right? Because the only other thing you have like that is Waymo, which is pretty expensive vehicle. It's like $200,000 or something. What if you could get it for $30,000? That changes the game. So we have to see what happens. That would be a pretty big catalyst. In terms of humanoid robot, I don't know if we'll get anything meaningful this year on that. I actually don't ascribe much of that in my valuation, but certainly the robotaxi news and something on the affordable car could be pretty important.
We shall see, Tom. Thanks a lot for joining us. Appreciate it.
Sure.
Now time for some of today's trending tickers. Let's start with NVIDIA and really the trend that we've been watching in the stock. It is moving higher today, trying to regain some of its recent losses. Of course, investors and analysts alike are eagerly awaiting CEO Jensen Huang's keynote address at next week's GTC conference, which we will be taking live. By the way, Jensen usually kind of rolls out new products, talks about some of the big mega trends within technology, and that GTC conference has become more and more important over the years for the company. But, Tesla, still got Tesla on the brain.
Anything that ends in A.
NVIDIA is the only one of the Magnificent Seven stocks that's actually up on the week. All the others, when I checked earlier today, that is, NVIDIA was up this week and all the others were still down.
Well, and NVIDIA, again, I almost wonder if we should take Tesla out of the Mag 7 at this point, right? But if you look at the Mag 7 X Tesla, NVIDIA had been the clear laggard, especially when you compare it to some of its peers that are riding very similar waves, the Alphabets of the world, Microsoft, Amazon, when it comes to the AI trade. And I think what's interesting for the stock heading into this event, which GTC kind of feels like it's overtaken WWDC, doesn't it? As like the biggest tech event. You look at the stock and it's trading at the same level it was back in June of last year. And it's had obviously plenty of ups and downs. We hit the record highs late last fall. We were down 30-35% in short order there. But I think the stock story for NVIDIA is anytime you get to that point where over a 1-year basis, it hasn't really gone anywhere. You've now had a lot of new investors either come in the name, churn out the name, looking for something else in the name, and you start to, I think 120 is a very interesting level for the stock looking, just at that price history. And as we get towards these catalysts, we'll have the event in March. Then we're going to go, or we're in March, so next week.
Yeah.
Then we're going to go 8 weeks till its next earnings report. So you're going to kind of go into a vacuum here with the stock kind of acting okay-ish.
Right.
And it's such a retail name, and it's because of the weight in the S&P, it's become such the kind of name that you're chasing even on the institutional level that it's a precarious spot for this.
Well,
for this
I think I come back to something Dirk Viller said at the top of the show from Citi, where he was talking broadly about AI. And he said the reason they're not more negative on U.S. equities is because the AI trade is still intact. It's just paused. Mm-hmm. It will come back at some point. The question is when, right? Does all the tariff noise have to die down? Something else I was looking at is valuations, right? Which people talk about with NVIDIA. And I'm not looking at forward P. I'm looking at the earnings that it has already made and what it's trading at. And there certainly are a lot of names that are a lot more expensive. I mean, Palantir, which is just wacky, right? At 450, ServiceNow trading at high, even Tesla, right? That said, NVIDIA is higher than most of the other Mag 7 stocks when it comes to its PE. Like, it's only second to Tesla, if we even include Tesla by your calculus, right? You've got it more expensive than Amazon, Apple, Microsoft, Meta, and Alphabet.
And, I think maybe we're overlooking we need to remind ourselves just how far the stock's come the last 3 years.
Oh, absolutely.
Right? And I feel like sometimes
Yeah.
I forget that, on a split adjusted basis, this was whatever, $15 stock 3 years ago.
Yes.
Right? And now it's 100.
And its earnings and revenue have risen accordingly.
Right. Speaking of something that doesn't have a PE, let's talk about gold. Another trending ticker here. Gold hitting a record high earlier in today's session. I believe it kissed 3,000 for the first time earlier this morning. We've got uncertainties over the economy, the escalating trade war. And this was another asset, Julie, that coming into 2025, you heard, and we're talking to Dirk Viller earlier about the setup for China. You had a lot of optimism around sort of the hated, not as interesting trades. People wanted to be long copper, long gold, long China. Things that weren't AI, things that weren't as cool as the NVIDIAs of the world. And this is a great looking setup here for gold. I mean, it's really had a pretty unrelenting rally. And I don't think much that has happened since, really, let's call it the last, since Trump was inaugurated, but even before that, the uncertainty that's come in with the global economic setup, the questions about the Bitcoin strategic reserve, are we going to open Fort Knox and count the gold, all this kind of stuff. All of this has been positive for gold.
Yeah, it's the ultimate duck and cover trade, as people, and it's really interesting to me that you brought up Bitcoin as well, which is supposed to be digital gold in the minds of many people. Hasn't acted like it, right?
Levered Nasdaq.
You know what's acted like gold?
Gold. That's right.
Right. So it's been pretty fascinating. There also has been a lot of talk about central bank buying of gold. That's been one of the things that's been underpinning it. We got a lot of strategists that have been continuing to raise their price targets. So they think it's still going to go higher. Now, it's like all of this said, this is not trading like an NVIDIA, for example. It's not up 100% year to date. But for gold, for it to be up like 12, 13% year to date is a big deal.
Look, it's a family program. I don't want to talk about the future of the U.S. dollar and, global monetary alignment and all this kind of stuff, but gold is telling you that there are questions about that from more than one corner of the investment world. So I'll talk about that later. All right, coming up here on this program, we'll have our latest edition of our series, Goodbye or Goodbye. We're taking a deeper dive into 2 stocks to help you make the right moves for your portfolio. Stick around for that and much more on Market Domination still to come.
It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye, our goal to help cut through that noise to navigate the best moves for your portfolio. Today, we're taking a look at investing plays amid macroeconomic uncertainty. I'm here with Washington Crossing Advisors Senior Portfolio Manager Chad Morganlander. He's a frequent guest here on Goodbye or Goodbye, and it's always good to see you, Chad.
Thanks for having me.
So let's get to the stock that you like here. It is Oracle. The stock's up about 20% or so over the past 12 months. It has gotten a big lift from the whole AI enthusiasm, Stargate, et cetera. So let's dig into why you still like it here. You talk about the shift that the business itself has done, not a sort of macro business shift, but a shift that Oracle itself has done.
Originally a database company, becoming a cloud computing company, becoming a cloud AI company, and then adding on to that, data security has been paramount. Oracle is one of the best when it comes to that. So we believe that Oracle should see a revenue lift over the next 5 years of at least 10% year over year.
And also, let's dig into a little bit the AI piece of that. and how that's going to play into Oracle, how Oracle is going to be able to benefit from it.
So first, they've had a backlog of orders now over $100 billion from all of the LLM companies out there. But the reality is the bigger revenue opportunity is how do you take corporate America and have this developed into a use case where it's actually being efficient and creating productivity and revenues. And Oracle will be on the leading edge of helping companies convert their data into the LLM models to then generate additional revenue that will be subscription-based. We believe that this potential opportunity is higher margin business than perhaps just training the LLM models.
And then I know the other piece of that is not just helping clients optimize revenue, but also helping them be more productive and cut costs. At least that's the goal of all of this AI stuff.
Right. So apparently they are the cheaper provider of database as well as cloud computing. But overall, what you've noticed is that IT spending across corporate America hasn't gapped higher all that much. So you could see this conversion where companies, corporate America, is moving towards using Oracle or Amazon Cloud Services or Azure Cloud Services. We believe that that trend will continue over the next 3 to 5 years.
We always like to talk about, as you know, what could be the potential risks to this thesis here. Maybe you see an overbuild. I mean, that's sort of there's been so much talk about that this year. You've got all these big spending plans on the part of the hyperscalers to try to build out all of this, but it's a crowded market right now. There's a lot of competition. How's that going to play out?
Right, and the concern is that this could play out similar to what happened with the dot-com era when it came to all of the fiber optics. We believe that they are much more careful in building out their network overall. That is a general concern, but we believe that they're not overextending with their capital outlay as of now. But that certainly is a risk, hence the reason why after the DeepSeek news came out, the stock traded off roughly about 15%.
And you do have a position in Oracle, I believe, right?
Yes, the firm does, and so does my family.
Gotcha. Okay, let's get to the stock you don't like as much. That is Capital One. Capital One shares are actually also up 20-ish% or so year to date. Like Oracle, they've come down from the highs with the recent sell-off. And this, you say, is a more economically sensitive name. I mean, big credit card issuer, where are its vulnerabilities?
So similar to your previous guest from Citi, the concern generally is employment trends. If you do have a moderation of employment, then you could see some credit card liability on their balance sheet. Also, the critical thing here is that as the Federal Reserve looks at these type of companies, they may be a little bit, let's just say credit conditions have been very easy.
Gotcha. What about financial conditions, though, that could potentially be changing?
Okay, so credit spreads when it comes to high yield bonds or investment grade bonds are pretty much historically at its low. Yes, it's wiggled up a bit, but any kind of normalization of credit spreads would be a major headwind for financials. They are very sensitive to the U.S. economy, to jobs, and most important, to financial conditions.
Right, so they might not be as profitable in that kind of a situation.
Correct.
Here. And then finally, abnormal volatility tied to leverage. Explain to us what you mean there and how that relates to Capital One.
Sure. So at Washington Crossing Advisors, we prefer not to buy companies that have an excessive amount of leverage. And what effectively happens is as you start to see financial stress or credit widening, the stock price starts to act and behave like a stock option. And you could see that it happens in such a violent manner that one should just be mindful that they're looking at a cheap PE ratio, maybe a dividend yield that is quite lucrative. But overall, as you start to see financial stress, the equity price reacts in just such a violent fashion that we would prefer just to kind of shy away from it.
I'm just curious, as an aside, are you elsewhere positioned in the financials, just not in a name like Capital One?
We would shy away from the big banks and the regional banks. We would prefer companies like the Visa or a Broadridge
Gotcha.
or a Marsh.
Gotcha.
We believe that that's a better way and a safer way to play it, in particular because financial conditions historically are very loose right now, still.
Gotcha. Interesting. All right, what could go right for Capital One? Well, an improvement of some of these things that you're talking about, financial conditions and credit spreads.
Or the Federal Reserve comes in, drops rates by a tremendous amount, and floods the market with liquidity like they did back in the last 10 years.
And if they have to do that, maybe we should be worried for other reasons,
Yeah,
right,
right,
Chad?
exactly right.
I would think so. All right, thank you so much for being here. Really
Thank you for
appreciate it.
having me.
And thank you so much for watching Goodbye or Goodbye. We'll bring you new episodes at 3:30 p.m. Eastern.
All right, first it was Canada and Mexico, then steel, aluminum, lumber, oil, and now champagne. President Trump's fast-evolving tariff policies have weighed on markets, consumer sentiment, and they create myriad challenges for importers, retailers, and more. Joining us now to discuss these challenges and more is Pauline Brown, the former chair of LVMH North America. So Pauline, let's just start with how a merchandiser, an importer, can even try to plan around this kind of environment when you're looking 12, 18 months out into the future on what assortment you're going to need, both for your customers, for your folks on the floor, and for all your stores.
Well, obviously it's not easy. It's easier than it would be if this were a fashion product, because champagne that you buy now isn't going to be a different brand or a different style in a year from now, assuming that it's some vintage that's already been made. Most champagne that you buy, even the newest champagne, is 6 years old. So that's good if you are in a position to be able to shore up in preparation or in anticipation of tariffs. But it isn't going to be easy. Keep in mind that the majority of these buyers are not just the distributors. It's restaurants, it's bars, it's clubs. In fact, about a third of the business in the U.S. Within that sector is what we call on-premise. And a lot of those local restaurants, they're not in a position to double or triple their inventory.
And so that implies then, Pauline, that if the tariffs do go into effect, while you may get some effect of pre-ordering, right, trying to get ahead of the tariffs, what you're implying is those folks can't. And so therefore you are going to see again, this is an if, because we don't know if these are going to go into effect, right? Which is part of the problem as well, is planning around all of this stuff. But it does imply a hit to sales.
It does, especially when we're talking about champagne. About half of the world's champagne is consumed here in the U.S., so it is the largest market. And my alma mater, LVMH, is the largest seller of champagne, has the biggest collection of champagne brands. So it will affect them. Obviously, they are diversified, and the other segments of luxury, handbags, jewelry, fashion, that nobody, at least as of yet, is threatening to increase the prices, but time will tell, and it's definitely giving a jolt to these European players.
Well, and I guess on the time will tell. I think that's where, in these conversations with folks like yourself, or just even sitting here internally trying to figure out what to make of all this, it seems like one category is targeted, and you then must consider that perhaps another will face these tariffs and or any kind of other duty. And I'm curious how you might think about what's the tolerance for absorbing some cost? How much needs to get passed on to the consumer? At what point do you kind of lose your footing in terms of what you would like that price mix, style mix, et cetera, again, to look like out into the future?
If this had been going on during Trump's first administration, I would say much of the added cost would be absorbed in price. The luxury players are not in a position to increase price at this point. Number one, because they've tested the limit on that. Some of the brands like Chanel have been increasing over the last 5 years certain product categories and items by as much as 50%. And the customer, even the high net worth customer, is holding out. And you have a lot of other dynamics at play that are making this a very difficult year for luxury. It's probably the most difficult year that I've seen since 2008. We've had an unusually long run, and that was propelled by China, which is starting I would say, is the single biggest issue in the mix, but it isn't the only one. So I would say that to answer your question, the fact that this is happening now, amid all the macroeconomic and competitive issues at play, that this is going to really hurt a couple of the players.
Pauline, I know we've talked a little bit about this before, but the luxury consumer, is it that they are spending their money elsewhere, or are they, just like consumers sort of down the income strata, are they worried right now?
The luxury consumer is fine. At least the most affluent consumers, they're not happy about what's happening in the stock market. They're not happy about some of the issues in the housing market. but their spending habits haven't changed much. I think it's really on the supply end. I think it's the middlemen, it's the retailers for sure. I mean, we've just seen in the last few months the merger of the two biggest luxury retailers, Saks and Neiman's, and that it may be good for Saks's efficiencies. It really isn't good for the distribution dynamic. So there's an issue at the distribution. There's an issue at the proliferation of brands and products, and the fact that the customer's a bit, I would say, a bit fatigued. And there is the other point that I think were inferring, which is that there's a lot of other competing outlets for that spending. There's travel, there's entertainment, there's dining out, and I think in this current era, there is a little bit, at least in America, a little bit more interest in the experiential over the pure material.
Pauline, finally, I do want to ask a question about your alma mater, and more specifically Bernard Arnault, who has been a friend of President Trump, or someone who has tried to cultivate a relationship there. Does that do anything when it comes to tariffs, right? Does that, do you think that's part of the calculus when it comes to whether to impose tariffs on some of those goods from Europe?
Well, I'm sure it was part of the calculus when Bernard Arnault decided to attend the inauguration festivities. Was it part of the calculus in whether the administration goes through with this threat or not? I think there's so many different considerations and I think the way, if Trump were to were to follow through, I think he could justify that this will hardly put LVMH out of business. In the end, wines and spirits are just about 15% of the total sales of that group. They are 20 to 25% of the profit, so it's not that it's not going to hurt, but it's not going to put this company out of business, and it's probably not going to kick Bernard Arnault off of the top 10 most wealthy individual list. So I think he'll be okay, not happy, but okay.
Right. I don't think anyone's too worried about him specifically. Pauline, thank you so much as always. It's always great to chat with you. Thank you.
Thank you.
In the Yahoo Finance podcast, Financial Freestyle, host Ross Mack is joined by key guests to discuss their wealth-building journeys and what it takes to create a lasting financial footprint. Be sure to scan the QR code below to stay up to date with the latest, and tune in to Financial Freestyle every Monday at noon Eastern. Here's a look at the upcoming episode.
There's a couple things about planning that a lot of people won't tell you. One is the best plans begin to go stale the moment you leave the lawyer's office, for instance. You buy a new car, you buy a house, and if you don't refresh those plans constantly, there's always some assets out there. It doesn't handle all the other things associated with this, like bills and subscriptions and credit card payments and all those things that have to happen. Those are the things that can really tie you down.
With so much market volatility from President Trump's tariff threats, inflation, fears of a recession, many investors are looking for safer assets in an attempt to protect their portfolios. Joining us now to help us understand exactly how to do that is Eric Byrich, Sound Income Strategies Equity Portfolio Manager. And I guess set the table here first, Eric, because I imagine you're hearing from clients that, people still want to see a return in the market, but they want to do so perhaps in a better risk-adjusted way. Is that kind of the message that you're hearing from folks, and what are you telling them?
Most of our clients are actually pretty happy. The stocks that have been going down are the ones that went up too much, really. So we're actually up on the year. For equities, we are investing in high dividend stocks, typically things that have been oversold because they have a temporary problem, and low PE stocks. So our average PE is about 10 times or less. And our average dividend yields range between 3.5% and almost 5%. So we're giving people stuff that is yielding right now and has the same earnings growth on average as the market at literally less than half the price. So we have a different experience than, say, some of the clients that you guys might be exposed to that have mostly technology names and super expensive names with high expectations. That's just different than what we do.
And so, I guess, Eric, when you're looking out into the future, and maybe we'll bring it back to that rates picture, given kind of your guys' dividend slant, your income slant there, it feels like we just haven't talked about the Fed all that much in the last few months. And I don't know what it is, whether it's just Trump taking the air out of the room, the AI trade. I remember the good old days when it was all about the Fed. We've got the Fed next Wednesday, and I'm just curious how you're looking at that. And I think that you're maybe expecting a little bit of a more dovish turn from the Powell Fed than markets have anticipated the last few months.
We would like to see it, mostly because everybody else in the world has been cutting rates and we're behind schedule. The Fed completed the most aggressive rate hiking policy in U.S. history just last year, and now the yield curve is positively sloped, but it's still not perfect. And we would love it if the Fed cut rates a little. Of course, the Fed is concerned about inflation, and inflation has backed up a little bit. If you look at inflation over the long term, it's really averaged between 3% and 4%. The goal to get to 2% really only reflects that period where we were importing deflation from China, but otherwise we're actually in a normal inflationary range. So hopefully, and Mohamed El-Arian has said this as well, hopefully we'll calm down a little bit. We can cut rates even though inflation isn't at 2% of core PCE.
Fingers crossed, right? Let's talk about some picks that you have, because some of these are quite interesting. I want to talk about LKQ. This is not a household name, as evidenced by the fact that I struggled over saying LKQ. But this is an auto parts maker, and I know that you're watching the automakers closely. Why get into this one?
LKQ is like-kind quality, and what they do is they make non-OEM auto parts. And they're particularly helpful to insurance companies when there's an accident. If they can replace some of the damaged parts with LKQ parts at a lower cost. It saves the insurer money, it saves the car owner money, and it's actually deflationary. So in a period where people are concerned about costs, LKQ should do better. We have a lot of European exposure, and that's hurt them a bit. And they've also had a management transition. But prospectively, their earnings should grow, their sales should grow, and their margins should grow, which are all good things. It pays about a 3% dividend, so that's not too bad either.
And, yeah, and we were talking earlier, we opened the segment talking about, you have a lot of stocks that haven't necessarily gone up, but we like financials, and they've certainly done quite well over the last few months here, last few quarters. Give us a couple names you like in there, and just what, in your view, the state is of the financials trade. On the one hand, they've gone up a bit in the last few months. On the other hand, we're just barely getting back to levels we were at 15 years ago for some of these stocks.
Well, the financials is a broad universe. We saw a significant appreciation when the yield curve started going favorably and when the Fed stopped raising rates. But right now, I think you had a prior guest talk about some of the issues with the financials, and that is at the low end, you're seeing some deterioration in the subprime category, and lending has slowed down. So the financials with a better net interest margin spread than they've had, at least at the banks, that's favorable, and credit is generally pretty good. The expectation that's priced in is that the Fed will cut rates a couple of times, and that'll even give a better net interest margin. So I don't think the banks are as dangerous as their recent pullback suggests. They're up significantly over the last year, and I still think they're cheap. So one of the ones that we wrote about is something that anybody can buy and know, which is Citigroup, which is trading at only 9 times earnings. It's less than 2/3 of book value, and it pays over a 3% yield. If you look at the prospective earnings growth for Citigroup, which is now the realization of 3 years of effort by Jane Fraser and Mark Mason, sort of restructuring the company, they're supposed to have more than 20% earnings per share growth for the next couple of years. If they realize that, even if the multiple doesn't expand, the stock would be up by 50%. But most likely the multiple will expand, and that can give you an even better return. So we like Citigroup among the majors. Another one that we talked about in the notes is Corebridge Financial, which is a spin out of AIG for their annuity and life business. This is something that's trading at less than 6 times earnings. It pays a 3% dividend. And what you've seen with Corebridge is that annuity sales have taken off. And the reason they have is because rates have gone up, and annuities, which were unattractive for a while because they didn't pay out very much, are now paying out enough where people want to lock in some secure income. So they're doing better. As Corebridge establishes itself as a more stable company and they complete all of the separation machinations that need to be done, we expect the multiple to expand. So instead of trading at 5.8 times earnings, it might trade at a whopping multiple like 8 times. And you can see the stock up 50 or more %.
Eric, thanks a lot. Lots of ideas for people to consider. Have a great weekend.
Well, thank you. You too. Take care.
Thanks. Well, we're wrapping up today's Market Domination. Don't go anywhere. We got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.